Some near-term thoughts here. Erin, what's on your mind as you look at what's going on in some of the findings that we're getting at this point?
Yes, I think there are quite a few interesting things that really happened in February, or very noticeable in February, as we really got a secure sense of the stimulus plan that obviously was just signed in, as well as additional plans coming forward. And we've really moved from a growth economy, which we were facing for the past 2 years, into more of a cyclical economy. And that means that it's a more about value types of stocks. And one of the things that I look at just to monitor, this cyclical versus growth, is if you look at a value index versus a growth index. Mid-February, value indexes really took off and became that leadership. And this is also shown in a lot of sector rotation that we're seeing. And ever since from February 17th, if you just look at the S&P 500 value versus growth, there's almost a 10% differential just in the past months, where the value index is up over 5% and the growth is down 4%. So obviously there are a lot of things that are going on that are causing this. Not just stimulus, but also obviously interest rates. But I think it's really important for investors to pay attention that we're looking to see a very different type of leadership in the equity markets, and a very different type of behavior over the next 12 months.
Yeah, it's amazing to have seen that rotation, and now people seem unsure. They don't really know where to go, and that's why they sometimes use the barbell approach. Something you've been watching are the small caps, as Morgan Stanley downgrades this sector today, but they've done incredibly well in comparison. Do you still like that small cap ETF, the S&P 600 small cap ETF?
Yes, I do. I still believe in the IDR, though we have seen a big sector rotation, particularly in the large caps, where we've seen the tech stocks really get hit, and obviously financials and energy is doing well. There's been less of a sector rotation, or less of that type of dispersion within the small cap area. And small caps are also more poised for a rebound with a growing economy. And so because they are at such low valuations, relatively low valuations compared to a large cap, I still feel that the reward to risk is very high. And if you're looking at just simply growth numbers, profit growth, the small cap indices are expecting about 2.5 times the rate of growth, about 60% profit growth this year versus 20% profit growth for large cap. And they're still trading at about the same valuations as large cap. So for me, I think that given that we're pretty certain, we know the vaccine rollout's coming out, we know we have all this stimulus money, I think small caps are still an area of safety, and an area where there's a lot of room to grow, just purely on a valuation appreciation basis.
Right. What about, the rising rate environment? Tell me what your thoughts are. At what point would you say I'm spooked by it, particularly for the small caps, which you're recommending at this time? But it may be a good thing for certain banks, right? And that's why we've seen some of the banks doing well. I know Merchants is a name that you like, right?
Yes. So Merchants Banks, it's my combination of calling for financials and small caps. It's a smaller mortgage bank. They only have 16 branches, so it's certainly not a household name, but they're really well poised to take off from, take off from, again, the suburban migration, increased home ownership, and also just more profits as we see the yield curve and the treasury yields rise. So I think that's just a great combination of growth as well as leveraging the advantages that we see within a lot of banks. But yes, the treasury rates rise is something that we're talking about a lot. Not because the rates are extraordinarily high, as we know the 10-year just crossed above 1.6, so still very low on an historical range. But what's really concerning is the rate of change, that we've gone from 50 basis points to over 1.5 in just a few months. And so, of course, we're concerned, well, if that trajectory continues, we could, be at 2.5% by the end of the year. And then that's something where you really want to start taking a look at whether equities are worth it and whether you should move some of your money from equities into bonds, and because bonds start looking more attractive. And so I feel that it's unlikely that we're going to see the massive rate of change that we've seen in the past 5 months. I expect it to be slower and more incremental, and more at the same rate of change as we're seeing with inflation, so more of a longer term of 2%. So it's really going to be where it crosses above that 2.5% is where you would see massive asset allocation and a potential detriment to the equity markets. And I think we're still a ways off. My guess is that we don't have to immediately worry about it for another 12 months, that It's just recently it's been a big jump.
Yeah, I was going to ask you about inflation. So as long as it's not moving quickly, you're okay with that. I mean, when you see what's going on here, as you talked about the quick pace that we've seen some of the yields on the rise, and right now inflation is relatively tame and rates are still behaving at least. The VIX is just above 20 at this point. So it seems that we're in this pause moment. Do you see more of a breakout or a breakdown?
I think we're going to continuously to be in this type of pause when the VIX trades between 20 and 30, and it just recently dropped to 20. It was more in the mid 20s for most of the months. That really says that there's a healthy balance between fear and confidence in the market, and that the investors are using both. And so we're not in a complacent or overly confident market by any means when it's above 20. And so I think that's going to be normal while we're still unsure about economic openings, right? We're still unsure about the timing of all of this. We're still unsure about exactly how, when companies can fully return to business as normal. And certainly, I think there are going to be some short-term inflation concerns because we do have some supply and demand issues as we start to open the economy up. And when there's those where the supply can't quite meet demand, you're going to see short-term inflections and short-term increases until we sort of figure it all out and slowly return back to normal. But overall, we still have an environment that encourages low inflation, and that's an older or an elderly population. They're not earning more money.
Yeah.
They had a fixed income that keeps the inflation down, and also price competitiveness. We can all go on Amazon and still compare prices, and so that's still very much part of the consumer world. And so those two factors are what's going to help keep inflation down.